Hey guys, what's up? It's Chad here. Just wanted to catch you up on a few developments here in my system. First of all, my S&P 500 versus bond system still says long S&P 500. So since somewhere around here it went long S&P 500 and we've done really well. Sorry, S&P 500 is in the bottom right-hand side of your screen. And it does look like we're going to 2400. And the reason I say that is because we started at right around here, the 2100. We went right about here, about the 2250, thereabouts. And then if you double that difference, that gets you to about 2400. So that's why it looks like it would add to the symmetry, and the markets often like symmetry. So uh, the systems are still long the S&P 500, but I wanted to point out this upper right-hand corner is TLT. We made a little bit of a breakout here today. So if you look at what we've been doing over the last couple of months, we've been making this sideways pennant, right? And it looked like we were going to break out here actually about a week and a half ago. What we didn't do it. We kind of found the support right around 118.5 and bounced off it. And here we are up at 122 again. Decent volume, nothing crazy like back here or here, but decent volume. So on Monday we'll see if we actually broke out of there. But that'll be very interesting because, as you know, I've been looking for a retracement in bonds back up, so yields to come down, which is what I've been looking for. And this looks like it may be the start of that. So we'll see. We'll see on Monday. Um, just to catch you up on earnings, earnings have been okay. Revenues have been basically in line. If you look at the entire S&P 500, 82% of the companies that have of the S&P 500 have reported to date for the quarter, and revenues have been about in line. Earnings have kind of disappointed. So earnings are interesting because we can sort of guess that how many companies will exceed expectations or not reach expectations. So in the typical earnings season, most companies will exceed expectations, like about 2/3 or 70%, roughly around that area, will exceed earnings estimates for the quarter. And this quarter, it's been close to that, but it's been a little bit lower than average. But actually what's a little more telling is that most companies will exceed earnings estimates by more than 4% on average. But this quarter, the excess of expectations has been down in the 2% range. So it's actually been lower than usual, or than we would expect if we're looking for average earnings beats. So that's kind of interesting. Just thought I'd throw that out for you, just some food for thought. Whether we're going to slow down or not, that's not necessarily on the horizon. I think most analysts are still estimating growth for the rest of 2017. Back in 2015, we saw an earnings recession where earnings dropped for the S&P 500. But now the S&P 500 is actually at an all-time high for our price-to-earnings ratio since 2004. So our forward-looking PE ratio is 17.6 according to FactSet, which is getting up there. It's getting full valued. So back in the late 90s when we were in the tech bubble, our forward-looking PE ratio was all the way up in the high 20s, like 28, 29. It was super high. So I think that is kind of skewing our average for the last 15 or 20 years at least because of that. But we're definitely above the averages, and so you can't continue like this forever. And most prudent money managers will tell you that you'll do much better if you start investing in a time where PE ratios are, down around 10, 11, and they do get down there during bear markets. In fact, if you look at the PE ratio between now all the way back to the tech bubble, we had a big drop in the stock market up until 2001, and then we had a run up until the financial crisis. But all that time, actually, PE ratios were coming down, which is really interesting. Even even after the bear market that followed the tech bubble. So between 2001 and 2006, 2007, when markets were going up, we still saw PE ratios falling for a lot of that time, which is kind of interesting to me. But they've been rising for a while now, so it's time to be a little bit more cautious when investing in the stock market. So it's hard because bonds are so expensive right now. The TLT hit its highs just recently and just started falling at the end of last year, and everybody's calling for rates to start rising. But if the stock market eventually takes a dip, then bonds will probably recover a little bit. And in general, we all know that nothing in the markets moves all the way in one direction forever. It's always ups and downs. So even if people are predicting an increase in yields in the bond market, it's not going to all happen at once, obviously. This has been like a 30-year bond bubble, basically. Bonds have been going up for a really long time, and they very well may go down slowly over really a long time. So even if people are saying, we're not going to go to 0% rates anymore because the economy has improved, that's great, but that doesn't mean we're going back up to 6% yields anytime soon. So anyway, all right. Hopefully y'all had a good week and have a great weekend, and I will talk to you next week. All right? Okay. Have a great one. Bye-bye.